investors at the Treasury Bills market are reacting to the 400 basis point hike in monetary policy rate by the Monetary Policy Committee as traders at Axis Bank expect a bearish market sentiment in today's trading. Meanwhile, the money market is expected to witness a decline in rates on FAAC inflows. Adamma Mbachu, team lead of currency trading at Axis Bank, joins me for this discussion. Adamma, thank you for joining us. Let's just get right into it. We saw investors pretty much trading cautiously last week ahead of the decision outcome of the MPC meeting yesterday, where we saw that surprise hike of up to 400 basis points. Just talk to us the reaction that you're seeing at the market and how that is changing investors' trading pattern.
Good afternoon, Esther, and thank you for having me. Yes, the hike in rate by over 400 basis points came as a surprise in the market, as market participants were not expecting the level of hike, although they were expecting a hike around the MPC rate. So what we saw was a bearish market. We saw a massive sell-off across the short and medium and long-term bills. And then we saw that happening in both the Treasury Bills market and the bond market as well, as traders wanted to sell off their funds to see how they can get improved yields on their asset and position themselves for buying, covering at a more improved yield. So we saw the sell-off in the market, but however, we saw that there's a bit of respite, given that there was an injection of about 600 billion FAAC into the system, which actually calmed down the market in terms of liquidity. And so we saw a bit of moderations. However, we saw the long-term maturities trading around 19% levels, while the short and medium-term maturities traded around 16% levels. In the money market, yesterday also it was affected by the outcome of the MPC, where we saw the overnight and the OBB rate hike to about 24 to 26%. But however, we have seen a bit of respite given the FAAC injection into the market, where we see the rate moderating to about 17 and 18%.
Now, I'm just wondering, going forward, what yields will look like, especially on the short-dated at the Treasuries markets now, 90-day, 364-day, where we saw 19% not too long ago. So how much more headroom could we see in terms of how much higher this rate's yields could go?
So we'll be watching the market cautiously, but we expect the rate to trade around the 19% handle, and then for the long-tenured bills, and then while we expect the short-tenured bills to still moderate around 18 to 17%, despite the outcome of the FAAC, because the market is actually driven by both liquidity in the system and also market sentiment. So both play in the market.
So for the 600 billion, I mean, obviously that gave market a boost in terms of liquidity. How much longer are you expecting this liquidity to last at the market?
Also, so we have the FAAC injection as well. And then for next week in March, we expect also maturities for the bonds, coming to the market. For March, we expect about 1 trillion maturing. So we also see heightened liquidity, in the future. So we expect also that for it to affect the rate and the yields in both the fixed income market and also the rates in the money market.
Finally, at the bond market, what maturities are investors most interested in that you've seen between yesterday and perhaps also today?
Sorry, I didn't get the question.
So for the bond market, what maturities are investors most interested in? Where are you seeing the most action?
Oh, yes, we saw a lot of activities around the 2029 maturities yesterday.
All right, Adamma, we'll leave it there. Thank you for talking to us today. Appreciate your time on the show. That was Adamma Mbachu, team lead of currency trading at Axis Bank.